Watch the Watchers.
Hello and welcome to a special edition of Oil Insights, which we would like to call The Watchers. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group, and I'm joined today by Jorge Montepeque, Onyx's Global Head of Benchmarks and editor of Onyx's The Officials publication. In fact, one could actually say that he is the official. Hello, Jorge. Before we start the show, please like and subscribe to the podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. At the time of this podcast, front-month Brent is trading around $72.50 a barrel. In our view, the path of least resistance for flat price this week is still weakness and further consolidation in the absence of a material change in the outlook for global supply-demand fundamentals, the economy, or even geopolitical tensions. Now, we've had encouraging manufacturing PMI data from China on Monday and the US yesterday. The second consecutive rise in China's Casein index was export-driven and likely reflected front-loading activity ahead of the imposition of tariffs when President Trump officially takes office in January. Although beating expectations, the US figure was nonetheless still in contractionary territory. This week, we see the release of US non-farm payroll data on Friday, but we do not expect that the data will nudge the Fed to lower rates faster when the FOMC convenes on November 17th and 18th. Therefore, the dollar will remain supported, acting as a headwind to oil and other commodity prices. The technical signals are not encouraging for flat prices, and risk takers such as money managers are still sitting on the fence and reluctant to materially increase their net long exposure to oil prices. As of last Tuesday, the money manager's long-to-short ratio on Brent futures contracts continued to trend at historical lows of around 2.4, well below the levels commensurate with oil pricing in the $80 range and above. From a fundamental supply-demand perspective, this week's focus will be the OPEC Plus ministerial meeting on Thursday, and today's podcast will discuss whether the producer group is stuck between a rock and a hard place. Jorge and I will naturally look at this meeting through a different pair of lenses, but we hope the viewpoints we express today will help you better formulate your own views and trading strategies around this event. So let's get started. Jorge, I want to first start with the timing of this OPEC meeting. It was originally scheduled for the 1st of December and has been delayed to the 5th of December, officially because there was some timing scheduling conflict with another meeting in Kuwait. Should we read anything into this delay?
I think we should read a lot into the delay, but let's start with the narrative, the official narrative. Number one, there is a very important holiday in Abu Dhabi, the national holiday, and MBS, the leader of Saudi Arabia, but by all practical purposes, flew in there to visit MBZ. In addition, there is a meeting by the Gulf Cooperation Council that was along the same time. But in the past, there have been those things, and the meetings are not delayed. So we can take the official narrative, which is a good explanation why the meeting was delayed, or we can say there's something else happening. And what I see is something else happening is a lot of dissension over what to do and how to do it. And typically in these meetings, you have the official meeting, the unofficial meeting before the official meeting, and it is in the room where it all happens. And then when the official meeting happens, it's just everybody's happy and they stress whatever.
So the rubber stamp comes after the unofficial bilateral or multilateral discussions, as the case may be. So maybe in the lead up to Thursday, all parties are not coming to sing from the same hymn sheet. Now, in terms of this meeting, the expectations, or at least the market consensus, is basically looking for OPEC to prolong its supply cuts. And the only question, I guess, in their mind, or what they're speculating, is how deep into 2025 that OPEC will actually push back. So if we look, just for sake of argument, at the IEA's November forecast in terms of fundamentals, if they hold OPEC production constant, or at least following the current supply cuts, they come up with over 1 million barrels a day of annual implied global stock build. So this is going to be a difficult question for OPEC in terms of their initial inclination to eventually return barrels. What do you think is going to happen at this meeting?
I think the outcome is predetermined, where they have to say that they're rolling over the existing system. Because if they don't say that, we're going to have a price reaction to the downside. So whatever they have stated that officially the UAE can do, and the 180,000 barrels overall growth and all those things, they will just be rubber stamp at the end of all this infighting inside. So there will be no surprises. But what it tells us is that the system is fraying at the edges, if not fully cracked at the center.
Well, that's going to be an interesting topic because we have that coming up. So I suppose in this context, where we're heading into a meeting, one has actually asked the question of compliance heading into this meeting. And when we look at the various reported figures for OPEC crude production, whether they're those of the IEA, those of the secondary sources that the OPEC Secretariat uses itself, and we compare them to our own information, and in particular for certain countries, we see that production is well above quotas. So it's one thing prolonging on paper supply cuts. It's quite another, looking at what is actually happening. And so we've seen countries like Iraq being admonished for overproducing, and we've seen countries like the UAE basically being spared condemnation.
Getting away with it.
That's another way of putting it. So I guess, we hear the mantra of compliance, compliance, compliance. So I guess we have OPEC having to contend with two big issues here, whether they prolong the cuts and how on earth do they get people to actually comply? What do they even have the leverage to get individual members to comply?
The issue is rather deep, because the figures that are used by all the agencies and all the analysts are wrong. We're very open about it, that the figures are wrong because
or imprecise.
Yeah.
Which is a different way of saying wrong.
They understate the actual production by UAE, Iraq, Kazakhstan, Russia, and I think a little bit of Saudi Arabia, as we are finding out
through the export figures.
Yes, correct. So they're all exporting more than it should, and the oil price is in the low 70s and wants to go maybe to some other place. But essentially, there is an official figure problem at OPEC, IEA, EIA, and all the consultants. And then this results in how to pretend that you have compliance when you know that the numbers are wrong, because everybody knows it. I have spoken to them. They all know it, but they have to pretend that somehow it's not happening.
Well, there's an element of face saving, I gather. But you raise a really interesting question, and there are certain countries like the UAE. We get the export numbers. We know how much refining capacity they have, and even as we speculate on that utilization rate and take the crude runs, take the crude exports, assume no stock change, and we actually get numbers well in excess of their 2.9 million barrels a day quota. We are looking at figures at least of 3.7, 3.8, if not above, depending how you treat condensates. But that's a big number.
Yeah, that's a big number, and it has been growing over the years. And anybody that questions that number kind of gets shun aside. And it's very interesting because we had a meeting with mainstream media in the past couple of weeks. And in a way, they're scared of bringing it out because then they don't get invited to the OPEC meetings. They don't get special access to the leaders. So in a way, they're a little bit complicit in this stuff. And I think that should stop, because who can make proper analysis when the most important commodity in the world is miscounted officially?
Indeed. And I mean, this is something interesting. I mean, we know the UAE has been granted permission for 2025 to raise its production by 300 kbd, and this is in accordance with increases in its production capacity, and this is not subject for negotiation at the coming meeting. And so, given how much the UAE currently produces, or at least what we think at Onyx where they're at, this 300 kbd is neither here nor there. But sticking with the UAE, and I want to rebound on something you said earlier. I mean, this week, Saudi Crown Prince Mohammed bin Salman met with the UAE President Sheikh Mohammed bin Zayed. And that is very interesting because in terms of the history of OPEC and the relationship between these two countries, clearly in the last 5 years, something is changing. And at least in my view, the UAE is trying to step out of the shadow of Saudi Arabia and is beginning to plot its own course. Now, where that course will take it, again, is a matter of conjecture. But how do you see the dynamic between these two countries? Because, you know, the UAE, yes, has been investing in productive capacity. Last couple of years has launched its own futures contract for Murban. Is there something here in terms of, you were talking about a crack in OPEC. Could this be a crack?
Yeah, the size difference in production between Saudi Arabia and the very friendly states, Kuwait, UAE, was Iraq, was not as big. It was very big in the past, but now is narrowing in, right? Because Saudi Arabia is producing 9 to 10 million barrels a day, somewhere in there. And the goal for the UAE is 5 million barrels a day. I was checking some of the data yesterday, and of course, the Upper Zakum field is Technip just got a new upgraded contract with them to increase production further. Where's this production going to go? It's not to keep it on the ground and have the valves there in a way rusting or getting full of sand in the desert. Is to get the oil flowing. And that means that gap between the two countries narrows and the relative power changes. And this is what has been happening.
I like this concept of gap because technically Saudi Arabia said between 9 and 10, that's what they usually produce. Maybe they're a little bit closer to 9 right now. But if you were to take, let's say 3.83738 million barrels a day out of the UAE, and we're talking probably in excess of 4.3, 4.4 maybe for Iraq, you put these numbers together and you get you come very close at least to Saudi's production. And so there is obviously shifting balances of power between the various members of the group. But the other thing in terms of plotting courses, and especially the UAE, it's interesting because obviously OPEC in general, producers have, in the context of energy transition, this decision to make in terms of whether or not their assets below ground get stranded or not. So either you monetize them as quickly as you can, or by the time energy transition has become or has had a significant impact, maybe you actually are not able to monetize these resources.
It is clear that oil is very important. And with the Trump going into the presidency, we're going to see a little bit of slowdown in the green revolution, which is indeed happening. But no matter what we want to say, there has been a change in China. And the EV transition is a reality there. And that is chewing up into gasoline barrels. And they're selling those cars everywhere. As you know, I am from Guatemala, and I was surprised that even BYD is being sold there now. So one way or
Truly
another,
global.
It's global. The electrical cars are taking over into some sectors, including in the UAE itself. All the families I spoke to are buying maybe a third or fourth car that is an EV and is very cheap to operate. So if you are an analyst and you're not political, you say, maybe we should do something and monetize the money now. What I can see from the actions by the UAE is we can blame them for cheating, leaking barrels, whatever emotional words you want to say, or you could say they're doing what they should do for their country. And what they're doing for their country is front-loading the money, which is economically that what one should do when the long-term prospect doesn't look so bright, shouldn't they?
No, absolutely. So, I mean, this is, for me, I think this is a question that is coming to the fore, and we understand and we acknowledge here that oil will be part of the future energy mix. That is without question, except its share will be different, diminished, modified. And yes, there are some countries that are going to be growing in oil intensity, like Africa eventually, parts of Southeast Asia. But we have the big consumers, those that led the super commodity cycle back in the mid-2000s, like China, who are, by design, going for a change in terms of the vehicle fleet for private transport. But I suppose we could say also the same for diesel and trucks, where compressed natural gas is taking a bigger proportion. So monetization of your asset, or maximum value for your asset now compared to maybe lower value in the future, that certainly has to be on the minds of any producer country.
Yeah, let me add something. The core raison d'etre of OPEC is to constrain supply at key moments to extract more rent out of what they have. Yeah. And what this has resulted in is unleashing alternative production, alternative energies globally, because you're extracting an over-the-market rent. And right now, they have to pay the piper, right? Because they
always have to play for the music at the end, right?
Yeah. Yes, correct.
So coming back a little bit to the more short-term aspects of this meeting, and setting aside compliance or overproduction and leaking of barrels, we look at the current projections of supply and demand, and of course they're not perfect, they're a snapshot in time. They're not taking into account the potential downside that there could be in demand if we have a trade war next year between the US and maybe the rest of the world. So when you think about it, I mean, OPEC is really caught between a rock and a hard place, or the sort of catch-22 situation, whereby if they increase production, like you were saying earlier, they risk a price slump. If they just keep the status quo, the supply cuts will invariably, mechanically, be affording less and less support to the price. So in a way, have they boxed themselves into one policy solution, which would be simply every time things get fundamentally weaker, we need to cut production, or at one point, they're just going to throw their hands up in the air and return to market share?
Ooh. These things are cyclical, in effect, and we could look at them from a very high level. And that is, if there's a trade war, the world would need something to boost the economy. And one of the solutions would be a very low oil price, because then you can kind of erase a little bit of the inefficiencies of the tariffs. But if one looks at it historically, every once in a while, it's periodic. Saudi Arabia goes, I had enough. I'm going to flood the oil markets. The position we're taking is that in that periodicity, I have a hard time pronouncing the word, we're about due for that. So I am expecting a big flush out in 2025.
Yeah, I think because, and I think this idea of being constrained or boxed in was expressed in an opinion column by Javier Blas from Bloomberg. Do you box yourself into this sort of one option situation, which is, well, I could only cut because things elsewhere are getting worse? Or at the end of the day, in terms of protecting revenues, if you think about it, you go, well, I maybe would like the volume over the price as a means of getting the revenues, and I will therefore eventually side with increases in production, recapture of market share. And if I have a low enough oil price to boost demand, then maybe I'll be able to fall back on my feet and get the revenues I need. Now, a longer term question for you, because I mean, this is certainly interesting in terms of how OPEC has to think about supply policy. And I'm here thinking about Iran. And obviously, there's a lot of consensus, which I don't necessarily share, that the US is going to go for maximum pressure on Iran and will be able to knock off, like in 2019, back in 2019, about 1 million barrels a day of Iranian crude exports. What if they do? What does OPEC do? Do they simply take the or at least tacitly accept the fact that there is a supply gap there that is contributive to tightening the market? Do they produce more? Could that be a trigger to actually initiate the reinstallment of barrels? What do you think?
Well, I have seen all the sanctions and maximum pressure put on Russia, and I didn't see any concrete results other than the industrialization of Europe and higher prices that we pay in the West. So Iran is a smaller country, perhaps has fewer options than Russia, but it's hard to bottle it in. So if there's an impact, one cannot write 100% Iran off. It will be a percentage of it, right? 10%, 20% max. What does that change in the overall global supply balance? Not much, is what I am saying. And the Chinese have arms that are able, as a sovereign nation, and they should, to exercise it and buy barrels directly, right?
They can. It was more in terms of the reaction of the producer group, because we've had these issues in the past where, and I'm not singling out Iran specifically, but we could mention outages in Libya, for example, that have been prolonged, where you lost 1 million barrels a day of production. So if indeed you have a policy, and again, it's debatable as to whether or not this time around maximum pressure will be effective as when it was first implemented, I suppose it, from an OPEC production policy perspective, either it offsets leak barrels and they simply stay put, or they could step in, maybe under moral suasion from Donald Trump on countries that have spare capacity, to actually fill the gap. It's something uncertain for me, but it's something also interesting in the context of how OPEC is going to operate in 2025.
Yeah, I think we can say that it's not bearish all the way. There'll be bright spots in prices, right? Either greater conflict in Syria, which is now growing, right? Which could touch other countries nearby, or more sanctions, or China going whichever way, saying, US, I really don't want to deal with you, or yes, I want to deal with you. What are they going to do? I don't know. But what I see is a willingness to work within the system. They don't want a confrontation. And I would suggest that maybe there will be some cutbacks on Iran, but not big ones. Yeah.
Are there any other big themes around this meeting this week that we haven't addressed that you'd like to talk about or share? Or have we more or less covered it? Are there a couple more items probably that we can mention before going into our crystal ball moment?
It's a repeat of the same, that those fractures, those excesses in production are too evident and that they need to address them.
Well, this brings us to the crystal ball moment. So let's assume that we get the expected outcome and OPEC pushes back the reinstatement of barrels into next year. And for sake of argument, let's say by the end of Q1, because in terms of periodicity, they could get together and reevaluate the situation. Trump would have been in office, maybe to get more clarity. So if they were to maintain the status quo, is your impression that for the balance of the year, prices still have downside, stay stable, pick up a little bit? What would be your view on it?
Very important. As the systems get rollover, the oil leak will increase by everyone, little bit, trying to make it unnoticeable. So this is a downcast on the prices. So in our view, it could happen as early as this month in December, where one day we can wake up and the market lost $4 overnight. If that doesn't happen in December, for sure in Q1.
So we have, and I tend to share this because, at the beginning of this podcast, a lot of the factors that drive oil prices are pointing to a path of least resistance that is lower. So yes, we have technical supports in and around the $70 barrel level, but it wouldn't be completely out of the question that we do catch a $60 handle somewhere between now and the end of the year. As I was saying a little bit earlier, for me, these quotas, even let's assume that they were fully respected, are providing a diminishing contribution to supporting prices because the demand outlook is getting worse and could get even further worse, if I could put it that way, should we have trade wars. So we're in a situation, and I tend to share the view that we could test somewhere in the 60s before the end of this year. It wouldn't be outrageous, given where we're trading. We said at the time of this podcast, $72.50 Brent for the front month. You could lose $2 very easily. Then you're at 70. Some other news comes out, and you're at 68. So not a big stretch to think that we could trade in the 60s.
And maybe let me add another slightly bullish comment there, is the weather seems to be colder than normal in Europe and in the US. And I think that's going to result in a healthier heating oil or gas oil cracks versus crude. And maybe there will be a little bit of a bullish impact over there overall for the crude oil price, but that's a temporary event. Yeah.
So we could say, abstracting from seasonal uplift, and so if we do get that cold weather, the gas oil diesel cracks increase, obviously is going to lead to greater crude demand, and maybe we get a little bit of offset there. But I suppose that once we're past the seasonality and we are in the middle of next year or early next year, it will be a difficult proposition to be holding above $70 per barrel. Well, I guess with that, we're at the end of this podcast. So thank you, Jorge, for joining me today. And let's see what happens on Thursday. Maybe we get a very rocky end-of-day session or a rocky Friday, depending on when they come out with their decision. So until our next episode, I invite you to, of course, smash that like button. That's my new thing, right?
What I would say is watch the watchers.
Watch the watchers, smash the like button, and of course, subscribe. See you next time.